Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, March 8th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with what the market's been doing this past week with a look at the market letter.
All right, we had another pretty rough week last week. The week before, we had that strong reversal as Russia and Ukraine were headed to the negotiating table, and that faded last week when they came up with actually nothing, and then Russia kind of intensified their invasion a little bit. We had on Friday alone, we had the European markets tumbled 4 or 5% on that day alone. They're all basically into a bear market right now, and our market we were down. Several hundreds, a big sell-off again. All the major averages ended up down for the week. The Dow, in fact, was down for a fourth straight week, and obviously will be down again this week for the fifth straight week. Yesterday, the Nasdaq and Russell 2000 closed in a bear market. Nasdaq 100 is down 19.5%, so it's we closed down today on that. That'll be in a bear market too. But anyway, what was going on? We had last week. We had crude oil prices surged again. They spiked above 115. That was last seen, I believe, in 2008. Yesterday we had a pre-market. We had a spike up to about 130. It ended up settling in somewhere around 120. Somewhere around 120 a barrel. Again, we haven't seen those kind of prices since 2008. A new high. In fact, it was the strongest market sector last week. It was up 7% on the week. We also had some buying into the defensive sectors, utilities, REITs, healthcare. They also outperformed. And in fact, we have the Dow Jones Utility Index making a new high. With XLU making new highs also. So if you're in the right spot, you're making some money, but it's been tough. Financials was the weakest group last week. It was down 4.78%. It also had a couple of rough days here yesterday. It was down big, but another 4 or 5% as yields were pulling back. Yields have fallen. The 10-year was above 2% here about a week and a half ago, and it had pulled down yesterday, intraday, I think about 1.68. We're settled, I think, right around 1.7% yesterday, possibly somewhere right around there. With the the different sectors last week, besides the financials, the growth sectors, technology, communication services, consumer discretionary, they were all down more than 2.5%. And what's going on right now? You're up until today, which we'll go into a little bit. You're not even having people aren't buying the dip, which is what they've been doing for a while. They're hoping they're going to find a bottom. They're watching last week's intraday low, or 2 weeks ago the intraday low, where we almost got down to it today. And when we had a little bit of a surprise when Ukraine said, okay, they'll if negotiations begin again, they'll withdraw their request to join NATO. But we were down 239 points this morning on top of yesterday's losses, and we ended up 586 points in the Dow. So a big spike. I'm not sure why it jumped up that much, because it wasn't. It wasn't that big a deal. But anyway, we had investors pretty much sell that spike as we're talking right now. We've erased that 586 point spike in the Dow, and we're only up 38 points at this point, and the S&P 500 is already headed lower. The technical condition of the market, as we ended up last week, had deteriorated some more. We had some back and forth trading last week that looked okay. We got some Fed chairs, semi-annual testimony on policy. before Congress. He pretty much inked in a quarter-point raise, which they've been debating here for a couple of weeks. The market liked that, but then of course that was short there. I think we ran up 500 points and we sold off the rest of the week. So we weren't able to stick on that. The yield curve flattened again as we talked about the Russian impact. In fact, right now, yesterday and today again, we have some of the financials as this yield curve spread is having making 52-week lows. I think yesterday we had Visa, J.P. Morgan, MasterCard made a new low today. PayPal made a new low. So this is we're getting to a point where you don't have an inversion in the yield curve, but you want to watch this 2-year, 10-year spread. As of right now, today when we're talking, we're at a 0.26% spread. That's the lowest it's been since the flattest it's been in a while. The banks just can't make any money on that. So I don't see a big spike in the banks, despite the fact that we should have some. The rates are going to go higher. The reason for that is because I think you're going to continue to see pressure on the 10-year yield, which is probably if that goes below the 2-year. It's forecasted every recession we've had. Now, the flip side of that is some traders will tell you that when the yield curve gets inverted, it's projected 20 or it's caught 10 of the last 20 recessions. So it doesn't always happen, but there's a good chance right now with all these sanctions and everything else that's going on with Europe that we probably will end up going into recession in the second half. And also we're already cutting earnings for the back half of 2022. Goldman Sachs yesterday came out there. They're all trimming GDP for the second half of the year. Probably about, I think in Europe they're cutting at 1 to 1.5% right now. I think they're down to about 0.75% for the U.S. So those are probably going to come down the longer this war goes on. We've talked the last couple of weeks about commodities as one of the places you want to be. The trade right now has been buy commodities and short tech. We had, on Friday last week, we had the CRB commodity index hit a new high. It actually is up, it was up 10% last week alone. Today we're having commodities jump up again. In fact, just a little while ago, they stopped trading in nickel at the London Exchange. I think the prices for nickel have doubled. You also had wheat. Wheat is almost doubled too. Now, one thing you want to remember on these things, when you hear about these commodity prices going up, it's not necessarily new buyers going in there and buying those. What you have is just like with the airlines, a lot of these miners and producers of the commodities, they short the commodities just to rein in what they're going to pay as they try to get try to even out the price of these things from storms and that kind of stuff. And when they get short and all of a sudden they have to cover, they drive the price up. So you'll probably see these a lot of these commodities start to pull back here later on in the next couple of weeks. It may take a week or two to do it, but you'll start to see some of those prices come down. Nickel doesn't double in value just that in 2 days or something like that. So don't get too excited about all that stuff. Okay, like I was talking a little bit before, the technical condition did deteriorate last week. It's deteriorated again this week. The different technical indicators are bearish and moving lower. We had we had a bearish crossover in the MACD on the S&P 500, the NASDAQ, and the Philly Semiconductor Index. All of the major averages are trading below the 200-day moving average, which is a bearish condition. The exceptions are the utilities, which is making a new high, made a new high yesterday, probably making a new high today. And the transports. Transports have been actually acting fairly well. They're still moving towards a correction, but you're having a pretty good a run in the trucks and the railroads, and that's causing just in fact to move the commodities. You're going to have to move them that way with the trucks and and the railroads. That's helping Dow Jones Transportation Index stay up a little bit, because with the what's going on in the Ukraine and Russia now, you're getting killed in the airline stocks and the travel stocks. Airlines were down yesterday. I know the U.S. Global Jets ETF, which has all the airlines in it, yesterday alone was down 11.19%, and that's off 41% from its high not too long ago. So that's something you kind of want to watch in here. That's holding the transportation index back a little bit. It was funny today when they announced the NATO thing. They thought maybe this will be a little bit of an end to whatever. The airlines all spiked up about 8 or 9% in a matter of about a half an hour. So that's if you're a trader, that's okay, but I would still kind of back off of that. Other travel stocks like Booking Holdings, that type of thing, have been getting beaten up pretty well. I think last week Booking Holdings on Friday alone was down about 5.5%. So these are places that you may want to just hold off until you see what's going on with Russia and Ukraine settle down a little bit. Investor sentiment is also it's at extreme levels right now. I talked about last week's market letter where we had the AAII, that's the American Association of Individual Investors. It actually had bottomed out about 2 weeks ago, but it's still at 30% of investors are bullish. That's down from like 39% historically. And then you have the pros, that's the NAAI, and that's the National Association of Active Investment Managers. They're showing only 30% exposure to equities. This is last week, and that's the lowest number since hitting 28.7% in April of 2020. So they're on the sidelines. They're not buying the dips yet either. Those are kind of extreme levels. But the thing about it is, just because something is like a market was oversold or just things get overly pessimistic, it means you may be close to the bottom, but you may not be at the bottom yet. So that alone is not a reason to jump in and buy. But it tells you that you should have a list of stocks here that you may want to look at. As we're speaking right now, that the Dow's back down about 50 points. So that little bounce that we got from the Ukraine settlement talks there has already disappeared in the market. As far as what needs to be looked at is it's all commodities. That's what's hot right now. As far as the industry groups last week that were still strong, we had aluminum, we had oil field equipment, oil field drilling, and you're getting a lot of activity in coal. And with crude oil prices moving up, you're also having a lot of people jumping in and buying the alternative energy investments again, and they're down quite a bit. I was checking just before we came online here. There's companies like symbol HASI, Hannon Armstrong. They've gone from about 40 to 50 here in the last week or two. That was up around $65 here just at the end of the year. You have stocks like SunPower, SPWR. It had a high of 35. We were down here it was down to 16 again. Now we're back up to 20, 21 today. You'll get more action in those stocks. They're very oversold before. You're going to start to see some people nibbling on those things. And again, that's probably something that's going to take, that will last for a while, as long as the oil prices stay up like that. So anyway, we started off the week yesterday with another bad day with the markets were pummeled. Again, the European stocks were trashed. Commodity index jumped again. What was I looking at over here? Because the Nasdaq was the worst performance index. It was down 482 points yesterday, 3.6% of the day. All the major averages are now they closed at the lows for the year. And in fact, the Nasdaq, as it went into a bear market yesterday, has completely erased all of 2021 gains. And you have the I think the Dow and the S&P 500 have gotten all the way back down to erased all the way back to March. So despite what we thought, we had a great year last year. unless you're sold up there at the top, which is probably unlikely. You're giving back quite a bit of these gains. So it's not. I don't think it's time to be jumping in quite yet. But we just kind of watch this thing. As you can see, what happened earlier today, when you do get some signs of progress between the talks between Russia and Ukraine, you're going to see some powerful rallies on this thing as people jump in to buy that. But with the FOMC meeting is next Tuesday and Wednesday, you're still going to have, you're going to get Powell's testimony again after that, talking about rates. And some investment houses are still calling for 5 or 6 hikes during the year. Don't think you're going to get that unless this Russian thing gets settled quickly, which I doubt. We still got a lot of headwinds for the market. You're going to feel this at the pumps. People are going to start reining in their spending. The travel groups are going to continue to go lower, and it's just not a time yet. It will be a time soon, but it's just not a time to be jumping in blindly and buying stocks at this stage.
All right. So in last night's comment, you wrote about investors looking for a washout or selling climax, which you say hasn't happened yet. Can you talk a little bit about that and what our subscribers should be looking for?
Yeah. Okay. Yesterday or a couple of days ago, when we started out, actually about a week and a half ago, we had the market went down like 700 or 800 points, and then we actually ended up coming back. Volume was good. I wrote at the time that I thought that possibly, there was some nice divergence. We saw some positive signs in that. It was possible that we may have had a bottom in that, but it didn't have all the signs of a selling climax. And by a selling climax, what we mean by that is where the retail investor and even hedge funds, the market's been going down, it's going down, and all of a sudden we have another day where we gap down. You start seeing, the prices in stocks are dropping down 10, 12, 15%. There's no buyers. Nobody wants to buy it, and people are just happy to get out. Just get me out of this market. And I don't care what I get for the stock, I want out. You'll see the market go down, 4 or 5% possibly. And then all of a sudden, you start to see it hits a bottom, and then it starts to go up. And then it starts to catch fire, and it really starts to quickly go back up. And you actually end up the day, usually in the plus column, not by a lot of times, but you'll see this hammer on the candlestick pattern. It's a long, thin wick that hangs down, and it comes back up to the top. And you have like a little candle up there. And what the confirming signs with that. Number one, you want to see volume at least 50% higher than normal. If you, sometimes you'll even see a double volume. In other words, everybody who was short, they're covering. The institutions say, "Hey, this has gotten cheap. I'm going back in on this thing," and then it becomes like a stampede where they can't get back into the market fast enough. And when you see that, that usually is the bottom. You can almost call that. You'll start to see some of the indicators. You'll see the stochastics, give a bullish cross. You might even see the MACD, take a big jump up there, the trend indicators. But we have not seen that yet at all. Yesterday we saw the Dow. I think it was down. Let's see, what were we yesterday? Okay, yesterday we were down 482 points on the Nasdaq. That's down 3.5%. That's a big loss on that. Part of that was due to a 5% drop in the semiconductor index, but you ended on the lows of the day. Now, that implies that there's more selling to go. It wasn't cheap enough where you saw hedge funds or anybody going, "Hey, I got to buy this because we've reached a level now where I don't care how long it takes me. I want to own these things." That's why I've been saying that when you get stocks like Google, like Microsoft, like Apple, where you look at the charts and you go back to the previous lows, like we did here a week or two ago on some of the different stocks, and you put in a buy limit order, so that if they do go down like that intraday, you do get some of your stock. You may not get all of it. Sometimes they don't even hit that. And part of the thing that causes that selling climax is people that have sell stop orders in. The market makers will go down there and they actually will start to see the buyers coming in. they're going to drop that thing lower so they can take in all those sell stop orders, which also helps to trigger, the further downside on the market. But we still have to go through that, especially when you have a market that we're entering into a bear market like what we have here, and we just haven't seen that yet. So keep an eye on those things where, like say, where we come in maybe tomorrow, you're probably going to take out this gap or this low, intraday low from the S&P 500, which looks to me was around 41, I don't know, 41.20, something like that. I did some work on using the Fibonacci retracement levels on the charting system we have in MarketEdge. And unfortunately, some of the downside targets that you'll see out there, for the Dow, one of the first downside targets is 31,229, and then that's followed up with a secondary target of 30,450 to 30,600, which means we still probably have about 1,500 points to go on the downside. For the S&P 500, the first downside target using Fibonacci numbers would be 3940, and then if it breaks through that, then you're going to possibly have a 3840 to 3880 downside target. That would represent 1.38 2% retracement level on that, a breakaway from that. So those are some levels that if things really intensify or we do have a sell-off where it looks like we possibly would get a selling climax, you might see the market get down around to those levels. And if you do see those numbers starting to or getting close to that, those are probably as far as we're going to see to the downside, and that would probably be what would probably trigger the reversal on a selling climax. So if you keep those numbers, write those down. The Dow, the secondary target would be 30,600, or an S&P 3,842 to 3,880. Those might be levels on a sell-off or a selling climax that you would see a reversal. But until we see until you see something like that happen, where we see the big turnaround and we see on big volume, we probably still have a little bit of work to do to the downside. And just like when you're going to see these big rallies like we had today, which is part of the bottoming process, and it didn't stick. Those are problems that signs that we probably should have a little bit more work to do on the downside. So kind of keep an eye on there. I think we're getting close, but until we get that selling climax, I think you want to just stay on the sidelines and wait for that.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.